If you build your future by chasing the ETF that looks smartest over the last 12 months, the market will eventually teach you a lesson that feels personal. I have watched that happen for decades. People think they are building a portfolio. In reality, most of them are building a mood. When growth feels exciting, they buy whatever has the most technology in it. When fear takes over, they run toward dividends. When America looks unstoppable, they forget the rest of the world exists. When the world scares them, they suddenly want global diversification. They call that investing. I call it reacting. The money is not made in reaction. The money is made when you decide with a cold head what role each asset plays before the next wave of excitement or panic arrives. That is why I do not begin with the question most people ask. Most people ask which ETF beat VU. I ask what kind of financial machine are you trying to build, and can it survive your own emotions? Those are very different questions. If you only ask which fund had the highest 10-year return, you are treating the market like a horse track. You are standing near the rail, clutching a betting slip, hoping yesterday's winner will do it again. Sometimes that works long enough to make you arrogant. Then the cycle turns, leadership rotates, and what felt like intelligence is exposed as simple trend following without a philosophy. Now, I am not dismissing the value of history. History matters. A decade is not everything, but it is not nothing either. 10 years will show you what an ETF did in calm conditions, in inflation scares, in rate shocks, in technology booms, and in ugly drawdowns. History can tell you whether a fund behaves like a steady truck, a race car, or a rocket strapped to a lawn chair. But history is useful only if you understand what produced the return. That is the whole game. The first mistake ordinary investors make is confusing result with engine. They look at something like SMH and see a phenomenal decade. They see a 10-year average return north of 33%, and their eyes light up. They do not see semiconductors as a narrow, cyclical capital intensive choke point business at the center of the AI build-out. They see only the scoreboard. They see VGT near 23% annualized over 10 years, and they think technology is simply better. They see QQQ over 20% annualized and conclude that concentration is wisdom. They see SMO around 18.5%, VU around 15.3%, VTI around 14.7%, SHE around 12.2%, VT around 11.9%, and VXUS around 8.4%. And then they start arranging their future the way children arrange trading cards. That is not construction. That is collection. A portfolio that lasts is not built by ranking toys. It is built by assigning jobs. I want you to think like a builder, not a chaser. When I buy a business, I want to know whether it is the foundation, the cash engine, the growth lever, the inflation hedge, or the optionality piece. I think the same way about funds. The ticker symbol is not the important thing. The function is the important thing. That is the new frame, not what one. What job does it do? Once you start there, a lot of confusion disappears. If I wanted one plain, powerful, low-drama machine tied to the productive strength of America, I would understand exactly why people gravitate toward VU and VTI. They are not exciting because excitement is not their job. Their job is to capture the broad upward grind of American enterprise with minimal friction. VU does it through the SP 500, VTI does it through the broader investable U.S. market, including some mid-caps and small caps. Their fees are tiny, their structure is simple, their discipline is automatic. Weak companies lose weight or disappear. Strong companies rise. That is not brilliance. That is a system. Systems beat impulse. Now, between those two, many people waste a ridiculous amount of energy pretending there is some huge philosophical divide. There is not. Over the last decade, VO slightly outperformed VTI. Roughly 15.26% versus 14.66% annualized in the source material you gave me. The spread matters less than the behavior. Both are low-cost vehicles riding the same national engine. If a man cannot hold one of these through a 30% drawdown without doing something foolish, his problem is not ticker selection. His problem is temperament, and temperament, not intelligence, is what blows up most portfolios. That is why I say the foundation has to be boring enough to survive you. People underestimate that sentence. A great core position is not merely one with decent returns. It is one you can continue feeding when headlines turn ugly. When your brother-in-law says America is finished, when your phone is glowing red, when some much hotter fund is making you feel late and stupid. If your core is always changing, then you do not have a core. You have a wandering appetite. The second mistake is confusing breadth with protection. Plenty of people say they want diversification, but what they really want is the emotional comfort of saying the word diversification. That is not the same thing as owning something meaningfully different. Take VT. On paper, it is the world. More than 9,000 stocks across the globe, one elegant wrapper around a 0.06% fee, roughly 11.93% annualized over the decade cited in the document. That sounds beautifully complete. And for many investors, it is, if somebody told me they wanted one fund, one decision, one set, it and forget its solution for decades, I would respect that logic immediately. But there is a subtle truth people miss. Global does not mean equal market cap weighting, means the biggest companies dominate. And because America has produced a huge share of the world's largest companies, a so-called world fund still leans hard toward the United States. So when an investor says, I own the whole world, what he often really owns is America with some international seasoning. Again, no problem with that. The problem is not the structure. The problem is not understanding the structure. VEXs tells a different story. It gives broad non-use exposure across developed and emerging markets, thousands of companies, very low cost, but a much lower 10-year annualized return in the source, around 8.36%. That underperformance is exactly why so many investors abandon international exposure right before they need it. They buy it for philosophical balance. Then U.S. technology crushes everything for years. Then they grow impatient. Then they sell the laggard. Then leadership rotates later and they discover that diversification only works if you can tolerate periods where one part of the portfolio looks like a fool. That is the price of diversification. If you are unwilling to pay that price, do not lie to yourself and pretend you want global balance. Just admit you want concentration and move on, honestly. There is no shame in honest concentration. There is plenty of danger in dishonest diversification. The third mistake is misunderstanding yield. A younger investor hears the word dividend and thinks old, slow, mediocre. He thinks cash flow is what people buy when they are afraid of growth. That is sometimes true. It is also sometimes stupidity. Look at SCG around a 0.06% fee, roughly a 12.23% 10-year annualized total return in the material you gave me. A yield profile many investors find attractive. Companies selected with an eye toward dividend quality and sustainability, not just random high payout junk. People dismiss it because the chart is not as intoxicating as semiconductor funds or pure technology funds. That is exactly why it matters. A good dividend strategy does two things for a disciplined investor. First, it gives cash flow without forcing sales. Second, it lowers the emotional violence of the journey. You may think that does not matter when you are 30 and aggressive. It matters more than you think. Men talk bravely in bull markets. Then a real drawdown comes and suddenly their so-called long-term plan develops conditions and exceptions. Cash flow can keep a man invested. I like assets that pay me to wait. That does not mean I worship yield. Yield can be a trap if it comes from weak businesses with no real growth, but when a fund gives you durable companies, reasonable cash flow, low cost, and a long record of competitive total returns, dismissing it as boring is the kind of mistake made by people who still think markets are there to entertain them. Markets are not there to entertain you. They are there to transfer wealth from emotional people to disciplined people. Now let me say something that many investors do not want to hear. The most dangerous ETF is usually not the worst one. It is the one that did so well. You stop asking what could go wrong. That is where QQ, VGT, SMH, and momentum products like SMIMO deserve respect, not blind devotion. I understand why people love them. QQ concentrates you in the 100 largest non-financial companies on the NASDAQ. VGT goes even deeper into pure technology. SMH narrows you to semiconductors, the backbone of the AI age. SMO leans into momentum, buying the strongest trends inside the SP 500. These are not silly products, they are powerful tools. But a powerful tool is also an unforgiving one. A chainsaw is not a bad tool. It just punishes carelessness faster than a kitchen knife. That is what concentration does. QQ worked brilliantly over the last decade because the world was run by giant growth companies, software, cloud devices, semiconductors, digital advertising, and platform economics. VGT did even better because pure tech was the heart of that machine. SMH did best of all in the source because semiconductors became the choke point of modern computing, modern defense, modern data centers, modern AI, modern everything. SMIO excelled because momentum works until it does not, and the market rewarded leadership for an unusually long stretch. Wonderful. Now tell me what happens if regulation bites, if valuations compress, if capital spending slows, if a hardware cycle turns, if supply chains shift, if a narrow group of leaders stops being perfect. That is the question, not whether the last 10 years were magnificent, whether the next bad period will make you abandon the strategy. I have no issue with owning powerful engines. I own powerful businesses. I like strength. I like dominance. I like economic moats. I like industries with deep demand and hard replacement. But I never confuse a wonderful business with a wonderful price, and I never confuse a strong trend with a permanent law. That distinction can save you a fortune. If you are young, stable, patient, and psychologically built for volatility, I can understand keeping meaningful exposure to vehicles like QQQ or VGT. If you deeply understand the semiconductor value chain and can stomach violent cyclical drawdowns, I can understand owning something like SMH as a smaller intentional acceleration piece. But if your entire financial future depends on one narrow growth regime continuing forever, you are not investing. You are praying with a brokerage account. The fourth mistake is underestimating fees only when the market is kind. People love to say fees matter, but they do not feel fees. That is why fees are so dangerous. They are not dramatic enough to create fear. VEXUS at 0.05%, VT at 0.06%, SAG at 0.06%, VTI and VO at 0.03%. Those are civilized numbers. They leave the compounding engine mostly intact. SMO at 0.13%, QQQ at 0.18%, VGT at 0.09%, and SMH at 0.35% are still manageable in certain use cases. But now the burden rises, and the burden must be justified by role, not excitement. A man should be able to explain why he is paying more. If he cannot, then he is subsidizing his own lack of clarity. I have seen investors obsess over whether the market will return 8% or 10% while ignoring the simple arithmetic of friction. Friction is not sexy, but over decades it eats like termites. That is why simple, cheap, repeatable structures beat complicated cleverness far more often than the financial industry would like to admit. The fifth mistake is using a race to solve an architecture problem. This is what I mean. An investor says, VOO is great, but VGT returned more. That may be true, but the question is not whether VGT returned more. The question is whether VGT should replace your foundation or whether it should sit on top of your foundation as an intentional growth amplifier. That is an architecture question. If you answer it like a race, you end up rebuilding your house every year, and the market punishes people who rebuild emotionally. So let me tell you how I would think about this if I were starting with a blank sheet of paper and no desire to impress anyone. I would first decide whether my core identity is national or global. Am I comfortable building around America because I believe it will continue producing extraordinary businesses, capital formation, innovation, and shareholder value? Or do I want the emotional and structural simplicity of owning the whole world through something like VT? There is no need for drama here. Either choice can be rational. If I want the United States as my home base, I likely begin with VU or VTI. If I want one-ticket global exposure, I begin with VT. If I want deliberate non-use diversification in a U.S.-anchored portfolio, I may add VEXUS in a measured way rather than pretending it will lead every year. That is the foundation decision. Then I would ask what I want the portfolio to do for me while I am alive. Do I value cash flow and emotional stability? Then SHAD-CD or similar quality dividend exposure can play a role. Do I want a dedicated growth engine, knowing full well it will scare me from time to time? Then QQQ or VGT may deserve a controlled sleeve. Do I want a narrow, high-conviction semiconductor bet? Because I understand both the opportunity and the risk. Then SMH belongs as a satellite, not as the floor beneath my bed. Do I want to tilt toward what is already leading? Accepting that trend is a force but not a religion. Then SMO can play that role. Now, do you see what happened? We stopped asking which ETF is best. We started asking what each ETF is for. That is what adults do with money. Children ask what is coolest. There's another reason I am insistent about this. A portfolio is not just a basket of securities. It is a behavioral contract with your future self. That future self is not as rational as you think. When markets roar, your future self will feel invincible and will want more concentration. When markets crack, your future self will feel endangered and will want less risk. If you have no pre-written operating system, that future self will improvise. Improvisation under stress is how fortunes leak out of disciplined people. So write the operating system. Now mine would sound something like this. First, the core must be simple enough that I can keep buying it through bad headlines. Second, any aggressive tilt must be small enough that a drawdown will not cause me to betray the whole plan. Third, every position must have a written role: foundation, diversification, cash flow, acceleration, or tactical tilt. Fourth, costs must remain low enough that compounding belongs primarily to me, not to the product wrapper. Fifth, I do not replace the foundation with whatever had the best decade, unless I can explain, in plain English, why the economic engine beneath that fund is likely to remain exceptional and why I can emotionally survive the path that is an operating system. Without one, all you have is a collection of strong opinions and recent returns. Now let me give you the uncomfortable truth that almost nobody wants to hear. A lot of investors do not really want wealth. They want confirmation that they are smart. Those are different desires. A wealthy person can hold a slow, steady compounder for 20 years and let it do its work. A person seeking confirmation keeps reaching for the ETF that will make him feel clever at dinner. He wants to say he spotted semiconductors early. He wants to say he leaned into momentum before the crowd. He wants to say he beat the broad market because he saw the future. That hunger for identity is expensive. The market does not only tax ignorance, it taxes vanity. I learned a long time ago that there's tremendous freedom in building a portfolio that does not require me to be the most interesting person in the room. The foundation of great investing is not brilliance every quarter. It is the willingness to be appropriately boring for a very long time. If your core portfolio cannot survive boredom, it will not survive terror either. And yet I do not want to swing too far and leave you with the impression that everything should be broad, dull, and indistinguishable. There is room for ambition. There is room for asymmetry. There is room for specialized exposure. What there is not room for is confusion. If you are going to own VGT, say clearly that you are making a technology concentration bet. If you are going to own QQQ, say clearly that you are accepting concentration in large, non-financial growth. If you are going to own SMH, say clearly that you are tying part of your fortune to one of the most powerful but cyclical industries on earth. If you are going to own ESMO, say clearly that you are leaning into recent leadership and accepting the possibility of sharp rotation when leadership changes. I can respect every one of those decisions. I cannot respect pretending they are the same thing as owning the broad market. Language matters, precision protects money. Another thing younger investors miss is that recovery speed matters almost as much as drawdown depth. A fund that falls hard but recovers fast is emotionally different from one that drifts sideways for years. A concentrated winner can look genius in a long tech cycle, but if you bought it without understanding the cycle, the first long stagnation will feel like betrayal. Broad funds look less thrilling in the ascent, but they often feel more survivable because they are tied to many engines instead of one. Again, this is not about good and bad. It is about matching structure to temperament. The best portfolio on paper is useless if its owner cannot stay with it. That is why my advice to somebody building wealth is almost never to start with the most dazzling graph. I would rather a person own VU or VTI and keep buying for 20 years than own a more explosive fund for 3 years and then abandon the plan in the first ugly stretch. The compounding of an imperfect but durable system beats the compounding of a brilliant but abandoned idea. Now let me say one more unfashionable thing. The decade you just saw may not be the decade you are about to get. That does not mean the leadership must reverse completely. It simply means you should be careful about building a religion around the recent winners. When one corner of the market produces extraordinary returns for a long period, investors start treating that outcome as moral proof. They begin to believe it happened because that segment is inherently superior, not because a specific set of economic conditions, capital flows, and technological developments created a golden runway. That is how complacency forms. Then valuation stretches, expectations climb, ownership crowds in, and now the same asset that created the fortune becomes the asset that tests whether the owner learned anything along the way. A good decade should make you richer, it should not make you careless. So what would I tell a younger version of myself if he were looking at this exact list today? I would say this: do not build your life around winning the ranking contest. Build a portfolio that can carry your life without requiring constant intervention. Use VO or VTI if you want a broad American foundation. Use VT if you want one simple world portfolio. Use VEXUS only if you genuinely believe in diversification enough to hold it when it lags. Use SAG if cash flow and steadier behavior matter to your psychology or your income needs. Use QQQ or VGT if you want higher growth concentration and can take the heat. Use SMH only if you understand that great industries can still punish sloppy sizing. Use ESMO if you want a momentum sleeve and you understand momentum is a method, not magic. Then write down the percentages while you are calm, not after the next rally, not during the next sell-off. Now, because once the market starts moving hard, your brain becomes a salesman, and your brain will always know exactly how to justify what it already wants to do. That is the final trick. The market does not defeat most people through lack of information. It defeats them by turning their own feelings into investment research. That is why your real portfolio is never the one inside your brokerage account. Your real portfolio is the set of habits, limits, beliefs, and rules that determine what you do when greed gets loud and when fear gets louder. Get that right. And many ETF combinations can make you rich. Get that wrong. And even the best decade, winners can leave you with less money than a quiet index fund held by a man with less ego. So here's the mirror I want to leave you with. If the ETF you are most excited about got cut in half and then went nowhere for 3 years, would you still know why you own it? If the answer is yes, you may have a strategy. If the answer is no, you do not own an investment. You own a recent feeling. And recent feelings are a terrible way to build a fortune.